Ray and Joanne sold $60,000 of stock last year. Real gains, real profit. Their federal tax on that gain? Zero. Not because of a loophole, not because the money was inside a retirement account, not because of some advisor-only strategy. They simply sold in a year when the tax code gave them room. It's called the 0% capital gains bracket, and almost nobody plans around it. Here's what most people believe. If you sell an investment for a gain, you owe tax. Always. So they hold on. They let winners ride for decades, afraid of the bill, and never realize that, in the right year, the bill could be nothing. Because the mistake usually isn't owning the stock. The mistake is selling it in the wrong tax year. Long-term capital gains don't use the same brackets as your paycheck. They have their own rates, 0%, 15, and 20. And that first one, 0, is real. For a lot of retirees, it's a wide open window. To see it, you have to understand one thing: how gains stack. Picture your income filling a glass from the bottom. First, your ordinary income pours in: a pension, a withdrawal from a traditional IRA, the taxable part of Social Security. That fills the bottom of the glass. Then your long-term capital gains pour in on top. And here's the key: the 0% rate is about where the gains land. Any long-term gain that sits below the threshold line is taxed at 0. Only the part that rises above the line gets taxed at 15. So the less ordinary income you have in a given year, the more room there is underneath, and the more gain you can realize completely tax-free. Here's where that line sits for 2026. Married filing jointly, the 0% rate covers you up to $98,900 of taxable income. For a single filer, it's $49,450. That's not your salary. That's taxable income after your deductions. And remember, gains stack on top of your ordinary income to get there. So every year the question is simple: how much room is left under that line before you fill it? Let's drop Ray and Joanne into it. This is an illustration, but the brackets are real. They're retired. After their standard deduction, their ordinary taxable income, a small pension, a modest withdrawal, comes to about $30,000. Their 0% line, married filing jointly, is $98,900. So the room underneath, about $68,000 of space. They sell index funds with $60,000 of long-term gain. $30,000 of ordinary income plus $60,000 of gain is $90,000, still under the line. Every dollar of that gain is taxed at 0. Now picture the exact same sale in a high-income working year. That $60,000 in gains would have been taxed at 15%, a $9,000 tax bill. Same stock, same gain. The only difference was the year they chose to sell. But before you try this, one thing matters more than anything: which account the stock is in. The 0% bracket only works for investments in a regular taxable brokerage account. Gains inside a traditional IRA or 401k don't get capital gains rates at all. When that money comes out, it's taxed as ordinary income, every single dollar. And a Roth is already tax-free, so there's nothing to harvest. So this is a taxable account strategy. The plain brokerage account most people forget to plan around. One bonus: qualified dividends ride in the very same brackets. So in a 0% year, they can land tax-free too. Now here's the move the sharpest retirees make. After they sell those funds at 0 tax, they don't sit in cash. They buy the same investment right back. Why? Because they've just reset their cost basis to today's price, for free. There's a rule called the wash sale rule. If you sell at a loss and buy the same or substantially identical security back within the window, it can disallow that loss. But that rule applies only to losses. On gains, it doesn't apply at all. You can sell and rebuy the same day. So they harvest the gain at 0%, step their basis up to today's value, and shrink the taxable gain on every future sale. It's called tax gain harvesting, and most people have never heard of it. Now the guardrails, because this only works if you respect them. First, the gain has to be long-term. You must have held the investment more than a year. Sell too early, and it's taxed like ordinary income. No 0 bracket at all. Second, and this is the big one, a gain taxed at 0% still increases your AGI. And your AGI drives other things. How much of your Social Security gets taxed, your Medicare income-related surcharge, ERMA, and any ACA health insurance subsidy. So you fill the room. You don't blow past it. And third, this is a federal rule. Your state may still tax the gain. The sweet spot is those lower income years. Early retirement before Social Security and required withdrawals fully kick in. That's the window most people sleep right through. Ray and Joanne didn't find a loophole. They simply understood that the year you sell can matter as much as the investment you sell. The 0% capital gains bracket isn't hidden. It's printed in the tax tables every single year. The blind spot is that most people never plan around it. This video is for educational purposes only, not financial, tax, or legal advice. The brackets are 2026 figures. The dollar example is an illustration, and your situation will differ, especially how gains interact with Social Security, Medicare, and state taxes. Talk to a qualified advisor, because sometimes the biggest tax mistake isn't what you own, it's when you sell. If this showed you something you'd never noticed, subscribe. Every week we uncover one financial blind spot that can quietly cost families thousands, sometimes tens of thousands of dollars. And send this to someone sitting on decades of gains, afraid to sell. The right year might be closer than they think.